Thank you very much, Andres, and thanks so much for the invitation, especially to the conference organizers. It's a great honor to be at least virtual in the conference. It would have been nicer to be in Santiago, but this is the world we have right now. So this is a very nice paper. I enjoyed reading it. It's difficult to go after Georgia and Sergio because I mean they did a very thorough the presentation of the paper and summarizing the paper. But hopefully my discussion will add something that Georgia can implement later. Before I start, I have to note that these are my views. They do not represent the views of the staff of the Board of Governors or the Federal Reserve system. So let me see if I can. Okay, now it's working. So given that they did an excellent job, especially Sergio summarizing the paper, I'm just going to take one slide to do the summary. So the question that Georgia addresses is to look at banks hedging demand and assess whether that hedging demand has an effect on cover interest parity deviations, and in particular for emerging markets where this literature hasn't focused as much as compared to advanced economies. The methodology, there are two sets of tests. The first test are the pattern regressions focusing on 10 emerging markets and using the hedging demand needs of banks from extrapolations calculated by using the BI's international banking statistics. Then she also conducts a case study for Mexico where she has direct information about the hedging of banks and also their counterparties. So what are the results? It appears the hedging needs and positions of these banks are correlated with CIP deviations, both in the panel setting and in the Mexican case study. And interesting, at least for me, was this result about the global banks operating in Mexico, where and also in the panel she gets a similar result that these global banks with offices in these jurisdictions are driving most of the results. So where does this paper fit in the literature? So there's a big literature out there that has grown quite a bit in the past few years, which looks at portfolio balance effects. So how this portfolio changes or quantity-driven changes may affect asset prices. So in this vein, I mean, there's Gabe Mayori, and then more recently Greenwood, Hansenstein, and Sundaram. So this fits nicely into that literature where Georgia looks at these positions or balance sheet positions of these actors in this market and assesses how those can impact these asset prices. In this case, the price of forward markets or forward prices, FX swaps, so on and so forth. Now, this, at least in this context, this literature has spread into two subsets. Those that look at supply factors that may affect CIP deviations, and that Georgia mentioned it, and also Sergio, is the deviation attraction sign, which looks more about this counterparty risk and whether banks have enough capital to get into these positions, factoring in that counterparty risk. So this is more about the capital position and how that may affect the supply of funds in this market. Similarly, Du Tepper and Verdelan look at this more from a regulatory perspective. So when leverage requirements were changed after the GFC, banks, global intermediaries had less balance sheet capacity to intermediate in these markets. And that's probably why we observed some of this CIP deviations, so some of the persistent CIP deviations in the post-crisis period. More recently, and this is where Georgia's paper is probably more closely aligned, folks have started to look at this from the demand perspective. What are the demand factors that may affect this CIP deviation? My colleagues Gordon Leo and Tony Zhang have this recent paper where they look at net external imbalances in several economies, and they try to see whether those net external imbalances have an effect on spot and forward markets, and ergo on CIP deviation. So this is more from the demand side. So you can think about the Japanese insurance company that buys a lot of dollar assets and hold them in their portfolio. And for regulatory reasons, they have to match that. They have to close that currency mismatch, right? So they have a lot of dollar assets, they have yen liabilities, but the regulator asks them, you have to be hedged. So they have to buy protection, or they have to adjust their balance sheet to have zero currency mismatches. So they're going to demand a lot of hedging in these markets, and then that may drive this CIP deviations. So I think Georgia's paper focuses very nicely in this area, but there are hints of the supply side as well. So I'm going to talk about that in my comments and focus on that. And I think Sergio touched on this point as well. So Sergio did his explanation with equations. I like pictures. For me, pictures are simpler. So on the left side, and I'm going to focus on the FX swap market, because in the FX swap market, you're basically doing a spot transaction and a forward transaction at the same time. I mean, you can think a bit, you can separate the two and look only at the forward transaction. But let's look at the FX swap market. So in Georgia's setting, especially in the case study, what we have is that you have these foreign institutions. We don't know what those foreign institutions are, but we know that they want to buy Mexican bonds. And Georgia showed that that very nice graph at the beginning, where you see the explosion of foreign investment in local bond markets. So to buy those bonds, they need Mexican pesos. So they go into the FX market, borrow the Mexican pesos. They probably need to hedge this, so they also buy a forward. So they go to the FX market and do this transaction, get the Mexican pesos, invest them in Mexican bonds. And on the other side, you have the Mexican banks. The Mexican banks, but what they want to do is they want to have dollar investments. So they also go to the FX market. They provide Mexican pesos. They get US dollars back, and they invest in those dollar investments. So this is in a nutshell what's going on. And the imbalances on both sides is probably what's driving some of the CIP deviations. But I think we can think about this in a very simple supply and demand demand curve. So in the global FX swap market, the marginal arbitrageurs, or the largest arbitrageurs, are the global banks. So they're the ones that they go and intermediate in this market. And so this is like associated with what Du and others have found, that if this intermediaries face particular constraints, then that supply is gonna change. On the flip side, on the demand side, you have these insurance companies that I was discussing in Japan, Taiwan, or big asset managers that are investing in local currency assets, and they need to hedge those positions as well. So this is in a nutshell that market. So for example, what happens if there's an increase in capital requirements, the supply of funds in the FX market is going to decrease. You're going to have a CIP deviation. The P can be CIP deviation, the price of forwards, whatever you want to call it. But that's going to change. And this is the Du paper, right? So the supply curve moves, and then you observe this persistent CIP deviation. You're going to have the opposite side. This is the Zhang and the Liao paper, where there's a change in the demand for some of the local currency assets, or foreign currency assets in the case of Japanese insurance companies. They want to be in dollars, and they need to hedge that positions, and that suddenly, because of particular reasons, it could be monetary policies, something else, investment opportunities, whatever you want to call it. They need to, they're going to buy foreign assets that they need to hedge in some way. So this is the framework where we are, right? So here in Georgia's paper, I think the part that's complicated is that there's very little differentiation between the equilibrium outcome and the shape of the supply and demand curves, and what are the shifters that are driving the supply and demand curves. So to understand that a little bit, I would like to know what are the motivations for Mexican banks to hold foreign currency assets? Are they on the supply side or are they on the demand side in my chart? Are they actively buying foreign assets for a particular reason? Are they taking risks or something else? Or are they just providing a hedging to other actors in the economy that we're not measuring properly? And that's why we observe that they have a high dollar positions, right? Because when you're doing an FX swap, basically you're providing in this case, the Mexican currency, and you're getting dollars. You have to do something with those dollars, right? So in that transaction, it could be that you're doing this actively. You're trying to invest in something in the U.S., or you're doing it passively just by providing hedging. That's what's not clear to me at this point. And I think a little bit of clarification on that would be useful, because then you can think about this problem from a supply and demand setting. So who's supplying the hedging here, and who's demanding that hedging? And that's what wasn't clear to me. I mean, I think in Georgia's argumentation is more like the banks are demanding that hedging, but I could see it the other way around. I could see it where the Mexican banks are providing the hedging, and they're the marginal suppliers of that hedging in the market. And this ties to this role of the global banks, which was very interesting. So this adds another factor to try to figure out what's going on here. Are these global banks moving profits back to their parents? Are they funding their parents? What's going on with these foreign banks? Do they have these positions just because there's some internal capital market transactions that they have to hedge in some way? So I think that given that in Mexico, I mean, this is more of a subsidiary market instead of a branch market, these are treated as arm's length transactions. So if I'm Banamex and I want to send money to a city in New York, I have to do this transaction that has to be denominated perhaps in dollars, but the Banamex has deposits denominated in pesos on the other side of the balance sheet, so they have to hedge that transaction as well. So I think understanding a little bit about the institutional features would be useful to see again whether the supply and demand factors are driving this. So now, if you have the setting, if you buy the setting, then you can think about a supply and demand framework like Kojin and Yoga, right? And so look at this supply and demand curves and see how those are pricing different assets. In this case, the forward, the FX swap, so on and so forth. And then you can start thinking about, okay, so what are your supply and demand shifters? So take the example where the Mexican banks are supplying hedging and the foreign investors are demanding hedging. So on the demand side, I mean, you can think about an instrument or a shifter that could be the U.S. corporate yields. If the U.S. corporate yields are a substitute for Mexican bonds, then if there's something in the U.S. that's changing, maybe that's going to drive that. Or you can think about the rebalancing of Mexican bonds in a global index. I mean, Sergio pioneered some of these strategies, and Thomas Williams has worked on this recently. So if there's a rebalancing on some of these global indexes, I mean, the demand for Mexican bonds may change, and that's going to give you an instrument to try to see whether the demand for hedging is going to shift or not. On the supply side, you can think about the regulations that affect the Mexican banks. The global banks in Mexico, those foreign banks that have subsidiaries there, and also the other banks, and see whether the supply, if they're doing the supply, whether that's shifting that supply or not.
Ricardo, you have 2 more minutes.
Fantastic. So I'm almost done. So and you can apply this to the panel framework as well. Explore the importance of local bond markets across the emerging markets. I mean, you showed that very nice initial graph, and we have read a lot of literature about how bonds, local currency denominated bond markets are booming, and there are foreign investors in there. So again, use the Williams methodology to try to tease out that. You can also use, for example, I mean, if global arbitrageurs, global banks are the ones providing the funding in this market, in the FX swap market. I mean, look at their other constraints, look at their capital ratios and things like that over time to see whether that's driving that constraint. At the end, you have this event study looking at the Mexican monetary policy shock. But I mean, it was very close to lift up in the US. So I don't know how well you can identify that. So providing more on that, I mean, it feels like an afterthought, that particular analysis. So either provide more flesh to it to try to provide more a description of the identification, or just drop it. So I'm going to give you the same comments Sergio gave you, which is streamlining the paper in the introduction, for example. You only talk about your paper on page 6. So I think that has to be moved to the front end. I mean, what are you doing? What are your contributions and what are your results? Go straight to that. Final thoughts, very nice papers. I'm looking forward to reading the next version. And thank you very much.
Okay, Ricardo, thank you so much. Let's do the following. Why don't we see if there are at least a couple of questions that we can take from the floor. I remind all panelists that they can unmute themselves to ask questions or comment. Why don't we see if we have one or two before we hand back to Georgia the mic. Please unmute yourselves if you want to comment. I have one question from Andy Powell from the IDB. Let me mention it. What are the rules for currency mismatches for banks on bank balance sheets? Strange, they have long dollar positions. Maybe it's the global subsidiaries.
Do you want me to talk about that, Andres? Or
so why don't you take a few minutes to react to the comments by Ricardo and Sergio, and maybe after we can see if there are more people that want to participate.
Okay, great. Well, first of all, thank you so much, Sergio and Ricardo. So happy to see you as discussants for my paper. I really appreciate it. It's sort of an ongoing conversation. And Sergio, in particular, thank you for laying out sort of the mechanism. That was really helpful to clarify it. And thank you both for suggestions on the draft. And I think that this fundamental issue, Ricardo, you put it in a supply and demand framework, but Sergio, you put it more in like, why are the banks behaving this way? I think that's a really good point. And I have some ideas of how I can exploit the supervisory data to look at that. In particular, to your point, Ricardo, about the subsidiary, the internal markets, I believe I can identify the FX transactions with a parent. So I could do that and then sort of get more exactly who the foreign hedgers are. So that's one way to go. I did go in, you're right, with the assumption that the banks are doing this as suppliers or they're. So I did have a sort of implicit idea of their business model. And I would say that all of the global banks, they are intermediaries in Mexico. So they're creating assets in Mexico. They have loans there, dollar loans there. And I would love to, I think that's a great idea to sort of dig in more to why they're doing this, why they have these positions that they then need to hedge. And also build out the demand side story a bit more, because absolutely in Mexico, we have Japanese investors. We have a lot of the stories that are talked about in the developed markets. So I really appreciate those comments. And I'm not sure if there's any specific questions that I could answer, but they were all very, very helpful. And I completely agree that entrance into the bond market indexes, that's an excellent idea for a demand side shock. I think that's a great idea. On the supply side, we don't have dramatic regulatory changes in Mexico, but I think what you're saying is also to, I have to think more about how to go forward on. So maybe we can discuss more, because the capitalization ratios, the other work that we've done on the regulatory spillovers or global regulatory effects on activity in Mexico, they're not so clear that there's a strong effect on bank behavior. So I'll have to think about that side a little bit more. Okay, with that, a big thank you. And Andres, do you want me to talk a little bit? I saw, so the regulations on currency mismatch, and this was a great point, Sergio, about the maturity structure. So I am working on trying to see if I can identify the maturity structure of the foreign currency part of the bank's balance sheets, but so far that has proved unsuccessful. So I completely understand. Anecdotally, I think the 3-month is really the market where a lot of the hedging goes on. But as you said, this is more at the short end, and the bank's balance sheets, maybe they have much longer dated assets. That's a very valid point, and I wish I could exploit the maturity in some way, but so far I haven't been able to do that. I may have better luck in extending the sample for Mexico. So that's sort of what I'm trying to work on for that. And the regulations, and to this point as well, the regulations are both just the straight mismatch has to be at a level, a percentage of your tier 1 capital. But then in Mexico, and this is in Mexico, this is defined as our currency regulations, right? Our currency mismatch regulations. In other jurisdictions, you're going to have restrictions on the banks that may come in different parts of the regulatory regime. So we have a combined regulation that banks have to comply with. And the first is that straight kind of currency mismatch cannot exceed 15% of tier 1 capital. The second element is more about liquidity and the maturity structure of how those foreign currency assets are liquid or less liquid. And that it's a pretty broad, but there is some element there of the liquidity side to these currency mismatch issues. And yes, to Andy's point, yes, the global subsidiaries, yes, this is really a main point of the paper, is that these global banks seem to be driving it. So understanding more what's motivating their behavior hopefully will give more credence to the identification, and also give us an idea of, banks. We want these global banks on some level. We also want the foreign investors in our markets, but then there are risks associated with that, or there are trade-offs associated with that. So I hope I can speak to that in the next draft. The role of dollar reserves, Andreas, was that, it seemed to pop up on my screen a question about dollar reserves. I'm not sure if you still can see that.
We have a question from Mario Gonzalez, our colleague here in the Central Bank. He asks whether you have looked or not at the effect of dollar reserves in the central banks to see if that has had any effect on the variables that you analyze.
Mario, that's an excellent question for another paper, I think. I think that we have seen some just revolutionary changes in terms of, we saw a big buildup in Mexico for sure of foreign currency reserves, and this sort of started in Asia after the crisis there. But this is something, and there's a literature on central bank foreign currency reserve management and the motives for that. But we've now, since the pandemic, Mexico's always had a swap line with the US, but because of NAFTA, but other central banks now have swap lines with the US. So how the banking sectors in emerging market jurisdictions access US dollars or US dollar funding, I think that's a really excellent question, and also whether central banks intervene on some level. So, but it's beyond the scope of this paper, but I think that, yeah, there's a lot of interesting work to be done on that question, but it's really beyond the scope.
So I've been told that Andy Powell, who had a question earlier, has been made a panelist. Andy, if you can hear me, can you unmute yourself or not?
Yeah, I can, Andres. Can you hear me?
Yep, great.
Thanks for that. Yeah, Georgia, thanks for the paper. I came in late, so I'm sorry if I missed something.
No worries.
So my point on the global banks was, do you have the position of the global bank, or you just have the position of the subsidiary in Mexico? Because I mean, maybe they don't have a mismatch at all at the consolidated global level. So that would be important also, I think, to understand what's going on.
Yeah, that's a really valid point, and that's why I sort of emphasize that I'm using the BIS residence basis statistics. So I guess the question is, where do you want to think about the financial stability implications and where the risks are, right? I mean, that's the way I think about that. So in Mexico, for example, and perhaps this is based on the Mexican experience, we don't have branches, we only have subsidiaries. And so they have to report to us at a consolidated basis in our jurisdiction. So one way I can get at this question of the parent bank position or consolidated the parent bank level is that the hedging that's going on, I am pretty sure I can identify whether it's the transaction is with foreign counterparties is actually with a parent bank. So that means that I can observe it's not really an internal market because we can observe it, right? And that's why the regulators drew that ring, right? It's exactly so we can observe it. But I can see those transactions with the parent bank. So that might get to a question about how these global banks are functioning internationally. I do think that it's going to depend on the jurisdiction. Not every emerging market has this ring fencing. Mexico, we do it on purpose. We experienced, so Ricardo mentioned, are these banks repatriating profits to their parents? Well, we have a big US bank, and we definitely saw some dynamics that would suggest that, but I wouldn't say that's the norm. From the Mexico, and this may not be true so much in other jurisdictions, the bank's incentives are very much driven by the domestic market and the domestic market profit pressures for the banks. So, and they have to comply with our regulation in Mexico because they're a sub.